If you are a dividend investor, you've most likely heard of what the kids call the dividend snowball effect. But in today's video, we're going to dig deep into what the dividend snowball effect actually is, whether it's overhyped or not, and we're going to be digging into what the dividend snowball effect has done for me so far in my investing journey. And of course, I'll be sharing some own examples in my portfolio of how compound interest in the dividend snowball has been working so far and being transparent about it, something a lot of YouTubers today don't do. So if you appreciate that, make sure to hit the subscribe button for me and check out the Do Dividend Stocks Not Drugs merchandise. With all the money you'll be getting from the dividend snowball, it's one of the best investments in yourself you can make today. Thank you, and of course, roll the intro.
Hello, I like money.
So what is actually the dividend snowball? Is it an actual snowball you get from buying dividend stocks? Well, unfortunately, no. The dividend snowball is just basically a process for which you get those dividends from your favorite companies that you buy and invest in, and you reinvest them back into that stock. So basically, anytime you buy a stock, ETF, REIT, or whatever, you have the option to reinvest your dividends with your brokerage. Now, if you reinvest your dividends, you're going to be getting more shares at the end of the day. A big thing to keep in mind is that dividends are not free money and it is a taxable event. So for an example here, let's say that Apple stock pays a $1 dividend. Now, you had $100 and now you have $101. The next dividend you'll be getting will be based off that $101 that you previously got, and so on, so on. So your new dividend will be based on the new $101 amount of stock worth that you have of Apple with that dividend that you reinvested. In the short term, and with stocks with lower amounts invested and lower dividend yields, this really doesn't make much of an effect. But if you consistently keep investing, reinvesting those dividends, and adding more money back in your portfolio, the amount can be large over a long period of time. The thing with the dividend snowball and compound interest overall is it takes a lot of time for things to get going. Here's an example of my very short investing journey so far. You can see when I started investing in 2020, at the end of the year, I received $78 in dividends. In 2021, I pretty much doubled that and a little more and got $170. In 2022, I got $385. And in 2023, this year, I got $503. Now, obviously, this is due to me contributing a lot of money, but also the dividend snowball is slightly in effect here. I expect over the long term, looking back at this chart in maybe 50 years, that these numbers will be very close to each other and basically not look any different at all and not look anything what it looks like now. I expect there to be a huge jump between my ages of 30 and 40 and when my wealth building process really kicks up. I think the part that excites me most personally about like a dividend snowball effect is that the potential I could be reinvesting like a salary back into my dividend portfolio and just have massive compounding at 40, 50 years. It really gets me fired up when I wake up in the morning. Now, for the dividend snowball to actually occur, you do need a few things to happen with the stocks that you do pick or the ETF. First, they gotta be growing their business and free cash flow. That's the most important thing. As a result of that, you're going to see the other compounding effects, such as dividend growth, dividend yield, etc. But the main principles here are really dividend growth, dividend yield. If you consistently reinvest your dividends, there's a chance that over time, one of your stocks will be down at some point and trading at a pretty attractive dividend yield. Now, I hate yield chasing and buying stocks with 7, 8, 9% dividend yields. That's just a great way to lose your money over the long term. But there are some instances where there are businesses that actually have the cash flow to back up those yields, and they're just being naturally discounted for the market for some reason. A few examples of this are Altria, Target stock was trading near 4% yield just a while ago, and even Starbucks now. So I think when stocks go down and their yield is high, and it happens to be high, I think it's an amazing time to buy it and get your yield on cost up, which is the next point of this video. Yield on cost is another very important thing when buying into the dividend snowball. If you would have bought Visa stock like 10 years ago, your yield on cost would be like 15%, and keep in mind their current yield is about 0.8%, which is absolutely wild. This is to only 10 years, and that's actually pretty short term in my opinion. Now, I can only imagine in 20, 30, 40 years what the yield on cost would be if they continue growing the dividend like they have been. But when stocks are trading at a high yield and growing their dividend in the short term, there actually can be some results to the dividend snowball. This has actually been a recent example for me, and if you guys follow me on the community tabs page, which you would have if you're subscribed and turn on post notifications, wink wink, I recently just received $13.33 from one of my smaller positions in the portfolio, Altria. Now, Altria, as I mentioned, trades at a 9% dividend yield right now, and actually has been growing their dividend because they have the free cash flows to back it up right now. My last dividend that I received from Altria last quarter, so this is literally just 3 months ago, was $13.13. My dividend payment increased by 20 cents just in that one quarter from reinvesting the dividend at the high yield and the dividend growth involved. Now, obviously, Altria has a ridiculous yield right now, but with the research that I've done as an investor, I believe it's undervalued, and I believe that they have the cash flows that are still backing it up, and I believe the dividend is sustainable as for now, and I go through the earnings reports and I read all this stuff. I don't believe that Altria is a yield trap. They actually have the cash flows to back it up. Once their cash flows start declining, that's when I think it would be a yield trap, and that's why when I would actually sell out. Another great benefit to quote-unquote dividend investing in the result of dividends is total returns. Dividends add to your total returns at the end of the day, and if you're a young investor like myself, total returns, which include price appreciation and dividends, should be the main focus. Dividends could be an amazing side stream of passive income, quote-unquote, as you don't technically have to work for it. Once again, dividends are not free money. But another reason I love receiving dividends and reinvesting them is that I can naturally add to my positions of stocks over time without having to add any more to my original principal. The fact that you can naturally add to my position over time and grow my stake and build up my position even sometimes when I don't have the capital, it's really, really nice. Here you can see the crazy difference over the long term of the S&P 500's returns when the dividends are being reinvested back into the S&P 500. You can see how great total returns are compared to just capital appreciation over the long term. Big thing to keep in mind is how similar these returns were over the first 15-20 years and how over time really as yield on cost and dividend growth and compound interest did its work, how it really differentiates itself in return wise. This is so appealing for younger investors like myself, and that's why I'm so excited about this strategy. But wait, there are a few things that I want to disclose here. First of all, I think chasing dividends and stocks that only pay dividends is not the way to go. I think it is a coincidence that a lot of great companies in America and that produce free cash flow do pay dividends. As I mentioned throughout the video, dividends are not free money whatsoever, but dividends can add to your total return in your wealth building process over the long term. I cannot emphasize this enough. Do not chase dividend yield and sacrifice quality in your stocks. Trust me, you will lose over the long term. Just at the end of the day, buy really good businesses or the S&P 500 index and hold them for a long time and chill. That's it. I want to thank the sponsor of today's video, DividendData.com. It is the best investing software on the market today. They actually have a tool where you can calculate compound interest, use the dividend snowball effect, see how it really works in real life, and really just see how over time the dividend snowball can go into play. You can research hundreds and thousands of stocks, look at their free cash flows, financials, and determine if it's the right business for you. There's also a valuation tool on there, so if you're really interested in DividendData.com, use my link. It is in the description and it greatly helps the channel. Thank you for making it to the video. If you haven't already, hit that like button, subscribe for me, also turn on post notifications. Check out the Do Dividend Stocks Drugs merchandise, and of course, always remember Do Dividend Stocks Drugs. Have a good one.